Paramount Skydance plans to eventually combine its streaming platforms with Warner Bros. Discovery's. Is this the right strategy? Combining CNN and CBS and reliance on linear TV are also challenges. Listen on.
Welcome to this week's edition of Inside the Stream. This is Will Richmond from Video News, and Colin Dixon from Screen Media is with me. Of course, Colin, how is everything for you this week?
It's great, Will. Been a busy week in the industry with lots of news floating around about what's going to become of Paramount Skydance, Global, Warner Brothers Discovery, whatever the heck they're going to call this combined company. And that's what we're going to be talking a little bit about today, right?
Right. So listeners who listened to last week's podcast might remember that we actually got news of the of Netflix bowing out of the competition as we were recording. So we were kind of doing a little bit of ad hoc reactions last week. But as you said, we've both been following the news this week of what Paramount has been saying about their plans for integrating Warner Brothers Discovery. And so we just wanted to share some thoughts this week and really start at the point of a question that I think a lot of people have, which is what's going to happen with the HBO brand and HBO Max. This is a brand that we know has gone through a number of different iterations over the past few years, and I guess it's starting to come into focus, although not entirely clear. We're looking at a report in TV Tech, quoting from David Ellison, the chairman and CEO of Paramount Skydance, who discussed some of what the merged company is going to look like. And it looks like, and this is going to happen over a few years, but the idea is to combine the streaming portfolios of the two companies, Paramount and Warner Brothers, into one, it's reading now, quote, one stronger platform over the coming years. There are over 200 million direct-to-consumer subscribers today in more than 100 countries, positioning us to compete effectively with the leading streaming services. So looks like there will be some combination of the two services. Not clear at all what the branding would look like. And last week we discussed this, but just looking at the Nielsen Gauge numbers for January, Paramount had 2.3% share. Warner Brothers Discovery had a 1.4% share. So that would land them at a combined 3.7% share. Now, I think that, one of the big questions that's going to come out of this is how can they grow their overall subscriber base? And we had a little bit of insight into, from Antenna, that there are, from Antenna and public statements, about 132 million streaming subscribers for Warner Brothers, about 79 million for Paramount. Antenna says that in the U.S. alone, only about 21% of Paramount Plus subscribers have HBO Max. So that doesn't speak to what it is globally, but it does seem like there's a big opportunity for Paramount to gain more HBO Max subscribers. So we're going to be looking at that, I think, pretty closely, and also how the branding is going to work here with these merged services.
It's good to hear that they're putting so much faith in the HBO brand, Will. They were talking about it being a diamond star brand and that they're going to continue to maintain that. And I suppose that might give us a hint of where they'll be going with the branding of the combined services. By the way, they didn't give a timescale for that. They said it would be, quote, several years in the making, that they won't just sort of combine the companies and then slam the two services together. So that's probably a good thing, because I'm not sure I'm very keen on the idea of them combining the services at all, Will. There are two sort of axes here. One of them is a slam dunk. They should absolutely do that, and that is combining the tech platforms. So they're both on completely different software stacks. This is a strength of David Ellison. He's a tech head, and I think he and his team can quite quickly get Paramount Plus and HBO Max on the same platform. And they should do that. Absolutely lots of savings to be had there. If you're an engineer at one of those companies, you should be making sure you're on the right team. I don't know how you do that, because when the job's done, undoubtedly heads will roll. But so combining those, I think, makes a lot of sense. Combining the services, I'm just not so sure about, Will. This was something that Warner Brothers Discovery was very focused on when they first took control of the Warner assets. And they did indeed roll everything into HBO to create this thing called HBO Max, or Max rather, I should say, was where they finally ended up. And that was basically all the Discovery assets they put in there, and, you know, all the TV streaming assets, and of course HBO and all of the HBO assets. And they did this, they set the pricing, and unfortunately it didn't seem to work out quite well, because they began to reverse themselves and began to start removing the Discovery content. And they actually did remove the Discovery content to keep Discovery Plus separate in the end. And they took out a whole bunch of other content as well. So, you know, I think the lesson that WBD learned was, just because you slam the two services together doesn't mean to say you can suddenly start charging a lot more. There are a lot of constraints in the streaming market. And as we know, Netflix sets a high bar. HBO Max is already at or above that bar in some of its tiers of service. And I really think that they'll find they have a lot more restrictions in setting pricing. Just slamming these two services together does not mean they'll automatically be able to increase the price to the combined price of both platforms. So I'm not sure that it's the right strategy, Will, particularly bear in mind that the asset classes that they have in the two apps, there's some overlap between the two, more in the sort of drama and comedy categories than others. And then there's not overlap between the two, as in things like the cable assets and CNN, although there is overlap in news. But I guess we'll get to that later. Okay. Anyway, my net here is, I don't think combining these two services is a really smart plan. I don't think it'll optimize revenue for revenue earned for the content in a combined platform like that.
Yeah, it does seem like there are lessons to be learned from when Warner Brothers tried to do this with the Discovery content. A big asterisk there, I think, is that the type of content that those two streaming services had were very different. Obviously, HBO, premium content, some sports, really a marquee name brand, as we know. Discovery Plus, more reality-focused, nonfiction, not as much overlap between those types of content. I think the overlap or intersection between Paramount content and the HBO content is stronger. But, to your point, I think there's a real branding challenge here. Both brands are strong. HBO is a strong brand. Paramount's a strong brand. So they certainly wouldn't want to go down the road again of losing or submerging the HBO brand, as we saw with the Max decision. At the same time, it feels like Paramount is a strong brand also. They wouldn't want to necessarily submerge that either. So what is the way to work this so they get maximum value here? Seems like an interesting challenge, and that's before getting to the non-entertainment and sports assets like news, which I think we want to talk about. Yeah,
we do. And I will just say, people will remember that Paramount has basically eliminated the Showtime brand. And that was a long storied brand, perhaps not with quite the same allure as the HBO brand, but still with a pretty strong following over the last several decades. So that's already been submerged inside of Paramount Plus. what they're going to do, how they're going to manage this branding. And remember, we're not just talking about Paramount Plus and HBO Max here. Discovery Plus also has a substantial following, which has been reinforced since Warner Brothers Discovery removed the Discovery assets from HBO Max. And of course, there's Pluto, which is their free offering. So it's not clear if or how those other two smaller services will fare in this grand unification. I'm sure that they could probably benefit from a single platform at least. Certainly Discovery Plus, it's a little less clear if Pluto would benefit from being on the same platform as an SVOD service, since it's a fast free service. But how they go about combining those and leveraging them. Pluto has been very good at helping to promote Paramount Plus over the last several years. Has been suffering somewhat from underinvestment, as I think we mentioned last week. What will happen to that is not clear at all, but I think it's a very important asset to have.
Agreed. And so, again, let's talk about news. We have CBS under the Paramount umbrella. We have CNN under the Warner Brothers Discovery umbrella. And we also have the FCC chair saying that there are really no regulatory issues here, that it's a, quote, cleaner transaction than the Netflix transaction would have been, and it's going to be approved relatively quickly. So how do we decipher what's going to happen with these two leading news brands?
Well, as to it being a cleaner transaction, I think it's only cleaner because it's owned by Larry Ellison. It will be owned by the Ellisons, who are buddies with Mr. Trump, of course. But I don't think it's cleaner in that respect. But the interesting thing about the combination, and one of the things you mentioned, Will, at the beginning was, you mentioned the streaming share that it would have. It would have 3.7% streaming share. The interesting thing here is that really highlights how powerful the broadcast assets still are, because the Nielsen actually shows the total amount of time spent with media distributors, including their broadcast assets. And what we see there is, if you combine Warner Brothers Discovery and Paramount together on that basis, you end up with 13.7%. And since streaming is 3.7%, that means that the broadcast assets of those two companies still reach 10%, so still garner 10% of people's viewing. And I have a feeling, Will, that a substantial proportion of that is news. So those two assets, I think, are really important. But one of the things that I was reading in, I think it was on Core Cutters News, they were talking about how industry analysts are thinking about this. And there seemed to be some thinking here that the way the news organizations would break out was that CNN would be more focused on international reporting, since it's considered to be its strength, and CBS is stronger on domestic stories, and that's how things might break out. That's a really interesting idea, because I have a feeling that the folks at CBS would have something else to say about that. And CNN, is pretty strong in the US as well. It's just that it's very much out of favor with the current administration. So maybe that's where some of this thinking is coming. Obviously, the administration features very highly in this deal, with Brendan Carr saying, almost blessing the deal before it's come up for proper analysis. And whether they can maintain a neutral news organization is also up for questions. Of course, we know that they decided not to renew Stephen Colbert's contract, and allegedly under pressure from the administration, because Colbert, of course, is no friend of the Trump administration. So there's a lot of questions for me over what will happen with CBS and CNN in the combined company. I think for sure there's going to be rationalization of the organizations again, so we may see more firings. But how they bring those two newsrooms together, I don't know.
Yeah, I completely agree, Colin. And it's surprising to me that there is no regulatory concern about having these two iconic news brands under the same corporate ownership. And that's before talking about any sort of leanings, political leanings one way or the other.
Yep.
Just the consolidation of news in that manner. But, at the same time, as we know, people get news from lots of different sources. It's not the old days where TV ruled in terms of news consumption. So it is a shifting landscape, and that does provide a little bit more latitude. So we've got that. We've got the news piece as well as the entertainment piece.
Well, and I should say, actually, before we leave this, Will, I should say that Netflix has no news. So if they had ended up owning WBD and CNN, this would have been something very new for them, and quite likely it would have received quite a lot of investment in order to continue to grow it. Or maybe it would have been sold as a separate asset, but either way, it would have retained its independence and continued to go forward as a viable news organization, separately investing both in the US and international. So I don't really understand Brendan Carr's assertion that this deal is much less problematic than the Netflix deal. I will say that the combined companies, if you look at Nielsen's numbers, will have 13.7% share of total TV time, which is the highest for any media company out there. It's higher than YouTube, and it's higher than Netflix. And it's also considerably higher than Disney. So, I don't know how it cannot raise some questions, but I guess we'll see. Maybe it'll be up to the Europeans to put their concerns about the deal.
Yeah, and just returning to what this overall company is going to look like in the TV versus streaming equation, you and I were looking at some of the financials of both companies, and it looks like, if we're kind of putting the numbers together properly, it looks like the combined companies, and this is before any impacts on the revenue side other than just adding the two companies together, looks like about 52%, give or take, of combined company revenue would come from TV, and that would include broadcast and cable, and about 30% of the revenue would come from streaming between the two companies. So about $34 billion from TV, about $19.5 billion from streaming. And as we know from both companies, TV revenue in 2025 or Q4 was down for both companies. We all know the challenges that TV has. So a company that is still relatively reliant on TV revenue that's also now going to have $79 billion of combined debt on the balance sheet. This is a bit of a high wire act that still is very much, no matter what they'll say about it being a next generation media company, it's still very much reliant on traditional TV.
It is very much reliant on traditional TV, Will, and it is falling. That revenue is falling fast, as you say. Looking at Paramount Global and Warner Brothers Discovery's 2025 results, TV media revenue was down 9% for Warner Brothers Discovery, for Paramount Skydance, and it was down a whopping 12% for Warner Brothers Discovery. That, of course, is amplified by their loss of NBA. That really seems to have had a very substantial impact on their linear networks. So, you're looking at a business that's declining at a minimum of about 10% on average between the two companies. So bearing in mind that the two companies are earning $34 billion, that means from TV media, that means $3+ billion disappearing from the rolls every year, at least. And can DDC catch up to that? I'm not sure. So looking at the gains in DDC in both companies, we see $1 billion from Paramount Global, and we see a little bit less, only about $500 million from Warner Brothers Discovery. That does not make up for a $3 billion loss. And boy, do they need they need that money, because both companies marginally profitable. Actually, Warner Brothers Discovery is making a loss, and actually in 2025 Warner Brothers Discovery was marginally profitable, as was Skydance. So they cannot afford to lose that TV revenue at that rate, because they're not making it up in D2C. And they can make some savings in the back end as a one-off when they combine the companies, but they have to get growth now in that revenue, or they're gonna their total revenue is going to shrink, and goodness knows how they're going to pay off that debt in that situation.
Right, and on the DTC side, it's also, I think, worth remembering, as we talked about last week or maybe the prior week, that a lot of the growth in streaming now in terms of subscribers is very much related to sports and to tentpole events. And as you just mentioned, we had Warner Brothers losing the NBA, got Paramount adding UFC. So, some shifts, but these sports rights obtaining and renewing sports rights are going to be ever more expensive going forward, because they all certainly recognize the key role that it plays in growing and retaining subscribers. So that's another battleground I think this company is going to be fighting on, is, how do they increase streaming subscribers materially, and what investment are they going to have to make on the sports side, not just on the entertainment side, but on the sports side.
Right. And I think that's one of the points that David Edison has made many, many times, is that this deal puts them on a par with folks like Netflix, that they can now occupy a similar role. I'm just not convinced that they can, with carrying that amount of debt, can they really bid competitively on major sports rights and take on people like Apple, Google, and Netflix? I'm just not sure they can. They don't have the cash flow to do that. And they don't, so busy servicing all that debt, trying to pay down that debt, that I just don't think that they can compete efficiently there. And so it's a complicated picture, but it's also very difficult for them, I think, to compete in that market.
Right. We already saw that movie play not long ago when Amazon effectively squeezed out TNT from Warner Brothers on the NBA renewal. That was a situation where Warner Brothers TNT had a renewal right, but Amazon effectively outbid them with their Amazon balance sheet. So, yeah, I think more of this likely to be seen now with this combined company. So, major questions on the streaming growth side, and also major questions on the reliance of TV, legacy TV revenues. Yeah,
absolutely. Now, they are expecting the deal to be done by September, to get all of the regulatory approvals that they need and to actually complete the deal by September. In fact, they're so confident it'll happen by then, they're going to pay a penalty to Warner Brothers Discovery shareholders of 25 cents a share a month, I think they said. 25 cents a share until that deal is done. So, yeah, we should see the combination, at least if we believe them, and we believe they're going to get a soft ride through Brendan Carr's FCC. Then that should be done by September. And I guess we'll start seeing some of those changes take place. I think probably, if I were them, the very first thing I would do is announce a pretty competitive bundle of Paramount Plus and HBO Max. That would be my first move, I think, out the gate to get more people with only 21% overlap in the US. I think there's a lot of softness there, and they could get a lot of people by taking an aggressive bundling approach as Disney has done with, say, Hulu and Disney Plus. I think I mentioned it only costs you $1 more to get both than if you just sign up for one. So a sort of really aggressive push like that could bring a lot of people into both folds and have them take both services. And that would give them a little bit of leverage maybe in the future to win more permanent subscribers, keep those subscribers for longer. We saw from the antenna data last week just how valuable bundles are in reducing churn. So there's some things they can do in the short term with those services, which I think will be very, very beneficial for both. And maybe will give them time to reconsider their idea of combining them all.
Yeah, I think that would be a key point of learning by deploying a bundle, as you described, is an opportunity for them to learn what works, what do consumers of these respective streaming services value, and how to put together some more permanent, longer-term branding play here. So bundle is a relatively straightforward way of them getting started, and I think you're right. I think we'll probably see something like that early on.
Yeah, I do too. And hey, Will, I wanted to just mention one more thing before we go. Netflix isn't too upset. It's continuing to move forward. And there was an interesting discussion or interesting piece this week in another piece in TV Tech. And basically, they were talking to Greg Peters, who's Netflix co-CEO in Europe. The Daily Telegraph interviewed him. It's a London, an English newspaper. And he was really talking about he wants to work with more broadcasters to help them find their audience in streaming. Now, what he's referring to here is they did a deal last year, which I think we covered on the podcast, with TF1 in France, where TF1, a major French broadcaster, is now distributing most of its content through Netflix, including its live channels and lots of its on-demand content. Well, apparently that's working out pretty well for TF1, and Netflix wants to bring this to the rest of the world. In particular, it was trying to court the BBC, which announced a distribution deal with YouTube quite recently. So they're actually, talking there with the British to try and convince the BBC to come into the fold as well on a similar deal to TF1. But Will, I love this deal. I think this is a great development for everyone. It works for Netflix, even if they don't take any money or a lot of money. They don't need to take a lot of money from the broadcasters to partner with them to do this, because it will bring more people into the app and keep them in the app longer, reaffirming the value and increasing customer lifetime value, that all important number. It works for the broadcasters because it gives them exposure in an environment where they are currently not at and which continues to grow. So it gives them extra exposure. But there's another benefit to Netflix, and that is it mollifies regional governments, because they can, when people complain about Netflix taking their viewers, they can point at the fact that they are working hand in glove with broadcasters to help them find their audiences online, helping them grow additional revenues, obviously supporting things like advertising if that's something that they're earning revenue from. So there's lots of reasons why this, I think, is a great deal for all concerned, and Netflix can deliver a lot with the reach that it has. So anyway, they're not standing still. They're moving forward to continuing to increase the time that people spend in the app without spending a dime.
Right. And they're free, all well said. And they're also free from having to figure out how to merge two gigantic companies together, which two of their competitors are now going to be focused on for the next in 3 years or something, give or take.
Yeah.
So they're free to make these types of deals with European broadcasters and others.
I want to just mention one thing, Will. This is funny. A lifetime ago, I worked for Oracle, and I actually worked for Larry Ellison. And he used to talk about the fact that he was in a big battle with Sybase at that time. And he talked about how Sybase would go out and buy a company every time Oracle announced a new product. And that by the time they got to the real battle with Sybase, it was already dead because it failed to integrate all its services and do a good job. I wonder if the boot is on the other foot in this situation. I wonder if Netflix maintaining a strong focus on what it does best and leveraging its platform will be the thing that is insurmountable for this conglomeration of Warner Brothers Discovery and Paramount Skydance. So I don't know. we'll have to wait and see, but that's an interesting comparison there, I think.
It will be quite a corporate drama to see play out, and I'm sure we'll be getting news updates on it regularly. So let's leave it at that for today, Colin, our initial impressions. And of course, we'll be updating our listeners as we get more info.
You bet.
Okay, good chatting. And thanks everybody for listening in on this week's Inside the Stream. And we'll see you all again next week. Inside the Stream is a production of In-Screen Media and Video News, all rights reserved.